everyone. And I know that I have to keep time, so therefore, without much ado, let me straight get into the presentation. You've been told, the agenda is thinking long term. And just to set the background, I thought why this is important is because we all call ourselves as long-term investors. We all feel that we are in this game because we want to create long-term wealth for our investors. But I guess while our intent and our goal and our objective is fairly clear to us, but many a times in our journey to reach to these goals, we always forget how we are supposed to think, why we were here in the first place. We start valuing the short-term goals more than the long-term goals, and that is what creates a disruption in our journey towards wealth creation. So my idea over the next half an hour would just be to reiterate all the golden rules which have been written by our gurus over the last 70, 80 years, starting from no less than Warren Buffett, his partner Charlie Munger, and their own mentor Benjamin Graham. So we'll try and walk through this presentation over the next 25 minutes by way of the words of wisdom which have been given by these investment gurus. Before we go ahead, let me just run these two slides in front of you, and I would wish to have an answer from you before I proceed. So just have a look at all of these companies. Also have a look at these companies. Sorry. And now tell me what is it that is common amongst the 5 companies shown here, or the 6 companies shown here, and the other 6 companies shown in the previous slide. Sir, a little louder please. Multi-baggers. So basically, let's call them as wealth creators, right? We agree that all of them have been sustainable wealth creators. And like I said, the operative word throughout the presentation is sustainability. We are not interested in buying businesses which give us 2x, 3x return, or somebody sell multi-baggers over a couple of years period. And then from the third year, they wipe out all your wealth which you had created by falling down 50, 60%. So we are looking at sustainable wealth creators. Now, why have all these companies created wealth? Basically, if you look at the core reasons for them to create wealth, the most important one of them is that all of them had a very high return on equity. Are we all aware of concepts of return on equity and return on capital employed? All of these companies have one thing in common, and I would say if you go back and visualize all the wealth creators of the last 10, 15 years, 20 years, whatever time frame you wish to take and consider, only those companies which have had a high return on equity, high return on capital employed have been sustainable wealth creators, and you can take that as a rule with hardly any exceptions. At least I haven't come across any exception. Something which is linked to this concept of return on equity is the concept of cash flow generation. We must have heard many times people saying that business generates very strong cash flows. Businesses which generate high return on equity also generate high cash flows. And therefore, these are the businesses which have very low debt on their books. Many a times you would have heard about companies which get wiped out. I think the most common one doing the rounds right now are 2 companies, Jet Airways and SL Infra. The simple reason why both these companies, by the way, both of these businesses were great businesses. Jet Airways has been a great airline over the last 20 years. Zee TV still continues to be one of the best media properties in the country. Unfortunately, in both cases, leverage was very high. In case of Jet Airways, the debt had become unsustainable on the company itself. In case of Zee, unfortunately, the other businesses of the promoter were highly leveraged, and in order to save himself, he had to take debt from banks and give collateral as Zee TV shares. So basically selling the family silver in order to protect himself because of huge leverage in his other businesses. So therefore, again, Wealth creation will happen when the business is generating high ROEs, when the business is therefore generating high cash flows, and it does not therefore have any debt on its books. And this is the ultimate source of economic value creation. In the fullness of time, it is not your ability to buy cheap and sell expensive that gives you the sustainability of wealth creation. It is only your ability to identify great businesses which generate economic value because of all the things that I mentioned here, and therefore keep compounding your wealth as long as you stay with those great businesses. So again, why I'm making this clear right now is that in our journey towards wealth creation, we always try to take shortcuts. We know all of these rules. I'm only reiterating these rules to you, but I'm sure that tomorrow many of you would be tempted to buy a Punjab National Bank, either because the government is recapitalizing PNB, or somebody says that the corporate cycle has turned and PSU banks will now start to do well. Anyway, they are very cheap. What you have to ask as the most relevant question is, do these banks make high ROEs or sustainable ROEs or not? If the answer is no, you would do well to stay clear of them for a very, very long period of time. Now, obviously, I am a nobody when it comes to the field of investments. Many of you wouldn't have even known me. So therefore, I thought that when I speak to you about all these things, let me also quote the legends of the investment industry and how do they think about investments. So this is a great one from Warren Buffett, and I should confess that almost 20 years back, when I first thought of buying great businesses as buying businesses with high ROEs, this was the quotation which prompted me to dig deeper, which is that the primary test of a good business is the achievement of high ROEs and not high earnings per share or EPS growth. Many a times, a lot of you would ask this question, that this particular industry or this particular sector or this particular company has a high growth. Isn't it great for wealth creation? The answer is, so long as it does not show you high ROEs, it will not be a wealth creator. Don't get into that short-term trap of a business doing very well for a 2-3 year period without satisfying yourself with the sustainability of his ROEs. Many of you would have heard of Charlie Munger, who is the partner of Warren Buffett. Between the two, it is said that it is Charlie Munger who is the one who is more intellectual, who has prompted Warren Buffett to do certain things, as against how in the 50s and 60s Warren Buffett used to run his portfolio, and he too says the same thing. He goes on, in fact, to say that the best way to make long-term wealth is to buy businesses with high return on capital, and even if you have paid a slightly higher price for it, you would still end up with a great result. And I don't think I need to reiterate this. Many of you would have known HDFC Bank for the last 20 years, and 20 years is when I basically started my career. I remember enough and more people always saying that, why do you want to buy a bank which trades at 3.5 times or 4 times price to book? You obviously have SBI which trades close to 1 time price to book. But look what sitting patiently on a great business has done over a 20-year period. So, sorry about this. Now, while I say that these companies have created wealth, one of the reasons why they've created wealth is because they've all been high quality businesses. In some sense, I have defined to you what high quality means. A business with high ROE is a high quality one. And this is what, again, people like Warren Buffett have to say. And let me just explain this to you with an example. He basically says that by thinking and investing long term, or just by lengthening the time you stay with a great business, you can create wealth which you could have never thought of. Again, go back to this example of high quality businesses in the Indian context. Many of you would have heard about businesses like Nestle or businesses like Asian Paints, businesses like Page Industries. I can assure you that at no point in time, except for very, very brief points in time, which was like when the corrections happened in 2009 and the stock market fell precipitously, except for those periods, you would have never heard generally people say that Page is a great business and is also a great stock, and the valuations are also right. You would have typically heard people say Page Industries is a great business, Asian Paints is a great business, but look, it's expensive. And the point I'm trying to make is that this whole thing about expensive or cheap also depends on the time frame that you have. If you are looking to outperform the market every 3 months or every 6 months, you will never be able to stay with, like Warren Buffett says, these businesses over a very, very long period of time. And if you stay with these businesses for a long period of time, like he says, and at least history has shown, and all the 12 stocks that I showed in the first 2 slides to you, you could have created wealth that you could have never imagined. Please remember, none of those businesses were really cheap. As maybe Infosys was cheap in 1994 or 95, just after the IPO. Many of you would even remember that the IPO also could not get fully subscribed. But Infosys was never cheap after 97 or 98. And I'll show you data how even after buying Infosys at the peak, you have made money. Let me give you an example here by what I mean by high quality businesses. And this one, I think you must, this is an analogy that I've tried to draw, but I think this is how most investors behave. So imagine that you are driving all the way from Chennai to Hyderabad. While you are driving, you are stuck in, just at the initial part of your journey, you are stuck in this horrible traffic while exiting Chennai. And just when you are stuck in your car, you see that there are people on bikes who are managing to just go past you, because the bike doesn't really, it can go past even in a traffic jam. And after 15 minutes, half an hour or 45 minutes of this slow moving traffic, you feel frustrated and you say that, look, even a bike is going faster than me, and therefore you come out of your car, sell your car to anybody who's standing on the road at a throwaway price, buy a bike from someone, and then continue on your journey all the way from Chennai to Hyderabad. Believe me, this is what all of us do when we sell high quality businesses that we ought to be owning for a long period of time, because they are the engine of wealth creation. But because of our frustration, because we want to outperform and we want to keep performing every quarter, every month, every 6 months, we sell our jewels to buy low quality businesses which can never stay the course towards your objective of long-term wealth creation. This is a study which was done in the US. There were 2 studies, I'm just carrying one because of the authenticity of the data, and I felt much more comfortable with this one. This is a study done right from 1989 to 2015 by a person called Ben Carlson. The other study was from 1900 to 2015, but I was not too sure about the veracity of the data. Both studies say the same thing, which is that in any market period you look at, it should be a sufficiently long market period, 10 years, 15 years, 20 years, anything higher than 5 years. You would find no more than 15 to 20% of businesses creating all the wealth. 89 to 2015 is not a small time period. It's almost 30 years. In this 26-year period, 80% of the stocks in US did not create any returns at all. All the wealth of the last 26 years in the US markets has been created only by 20%. I can assure you, if you do the same study, and after looking at this data, I was tempted to do the same study. Maybe I'll have to make time for that. I'm very, very confident that this number of 20% would be on the lower side, not on the higher side. No more than 10 to 15% businesses, let's say no more than 100 companies in the country, are responsible for all the wealth that we have created over the last 30 years. And this again proves the point. You have to stick to high quality businesses which churn high ROEs, have sustainable growth, and stick with them for long and not get unnerved when things are going against you. Although the problem here is that this requires patience, and you would have already understood this, that it's easy, by the way, it's not easy to identify an HDFC Bank. It was never easy to identify an Asian Paints 20 years back or an Eicher Motor 10 years back. But even if you really have that ability to identify them, the bigger problem is patience. And this is where most people, despite identifying jewels, fail, because they are not able to stick to their chosen companies patiently. So by the way, Ben Graham was the guru of Warren Buffett. The only time Warren Buffett left his house in Omaha to come to New York was when he wanted to study at the Columbia Business School, because he knew that there is a legendary investor called Ben Graham who teaches finance there. And only for those 3 or 4 years, he came out of Omaha to New York and then went back again. He studied under Ben Graham for 2 years, was an apprentice under him for another 2 years, and then he went back. This is what Ben Graham said way back in the 1950s. People don't need extraordinary insight or intelligence to be a great investor. What they need the most is the character to adopt simple rules, stick to them. You just have to stick to those rules that you have identified for themselves, but stick with them patiently. Have you heard of Keynes? Many of you who would have read Keynes would have, read economics would have heard of Keynes. John Maynard Keynes was a noted economist, but he was never a very successful investor. He basically went in, came out of the market. So he was an intellectual, he was a high IQ person, but he never understood the dynamics of the market. It was after a very long, frustrating period of many decades that he had to write this about investments. He said that the spectacle of modern investments and the markets have sometimes moved me to the conclusion that to make the purchase of an investment should be permanent like that of a marriage, and it might be a useful remedy for all our contemporary evils. So this would force the investor to direct his mind to the long-term prospects and to those only, which basically means identify good companies and, like a marriage, stick with them for a very, very long time. If you think that you can sell HDFC Bank today because SBI in the next 6 months will make good returns, I can assure you enough and more people are attempting to play this game, which is also known as the greater fool theory, in the markets all the time. But people who stick with discipline and stick with the jewels, if they have identified them in the first place, are able to beat many of these professionals hands down. This is what Charlie Munger says: great investment requires a lot of delayed gratification. Unfortunately, stock markets, investments, mutual funds have become a game of instant gratification. You want your portfolio manager to perform every quarter. You never want his fund to slip into the second quartile and the third quartile. You basically want to go back to your investor and say that, look, I am in the best performing fund. It is nothing but a vicious cycle. You have to come out of that mindset to really generate long-term wealth for yourself. Paul Samuelson, for those of you who have studied economics, is again another noted economist, and he said it in a different way. He said that investing should be like watching paint dry or watching grass grow. If you have the urge for activity, you people should be going to Las Vegas. Stock markets are not meant for you. Warren Buffett said this in a very small sentence, which is that the stock market is a mechanism to transfer wealth from the active investor to the patient investor. And I think it sums up the entire psychology of certain long-term investors versus what I call as 90% of market participants who are nothing but speculators and traders, just trying to figure out what will outperform or underperform in the next 6 months. Lastly, the big problem is not only discipline. The big problem, like I said, is of course to start with identifying these jewels. The second big problem is, even if you have identified those jewels, sticking with them patiently, because there will be someone or the other who will always whisper into your ears that, look, what you're holding is a great business, is not a great stock. It won't do well over the next 6 months. It is too expensive. And that's the biggest problem with all of these. So let's also listen to some words of wisdom about, and this you would have heard from so many of people who claim to be intellectuals in the market, that a great business need not be a great stock to own. I partially agree to it, but never fully agree to it. So Charlie Munger says that it is far better to pay a fair price for a great business rather than great price for a fair business, which basically means don't feel happy about the fact that you have bought a poor business cheap, and never feel afraid of paying a fair price. It's not a cheap price, you're paying a fair price for a great business, because a great business is the one which will ultimately help you accomplish your objectives, even if you have slightly overpaid. Don't look at this. I'll, I'll just paraphrase this for you. This is Warren Buffett himself. Many of you think that Warren Buffett stands for buying businesses cheap. He buys high quality business, but he buys them cheap. These are his own words. Basically, he says, and many of you also have heard of this term value investing as investing which is buying businesses cheap. Warren Buffett defines value investing not as paying a low price earnings multiple, paying a low price to book value multiple, and so on. In fact, he says that oftentimes paying a high price earnings multiple or a high price to book value multiple could still mean buying a value stock, because what is more important is not the price that you pay today. What is more important is how would the value of that business grow over the next 5, 10, 15 years. If the value of that business is growing, even if you have overpaid 10, 15%, in the fullness of time you would still be fine. So concentrate more on how the intrinsic value of the business is going to grow, rather than whether you are buying it 5% or 10% cheap, or you're overpaying by 5 or 10%. Now this is what I thought is very pertinent to for all of us to look at, and I've deliberately chosen a period which goes against Infosys. So Infosys, for those of you who were in the markets then and who were closely observing the markets, would remember that the rally in Infosys started in 97 itself. It went up like a rocket in 97, it went up again like a rocket in 98, 99 he broke all records. I have chosen a period which is end 99. Of course, Infosys peaked in March 2000. I have deliberately not chosen that period because none of us are as foolish to have bought Infosys only on the day when it was at its highest valuation. But I have still given the benefit of doubt that some investor who kept looking at Infosys, he kept thinking that this is an expensive stock, great bought stock but expensive stock, but by the end of 99 capitulated and he said that even if it is expensive, let me buy it. At that point in time, Infosys was trading at a PE multiple of higher than 50 times. Look at what happened over the next 5 years. Infosys still, even from that high PE, gave you a return of 19.5% CAGR. The markets gave you a return of 8% CAGR. If I were to reduce this time period to 3 years, the results are even better for Infosys, because for those of you who remember, 2000, 2001, 2002 was a horrible period for the stock markets. 2003 August is when the market started to move up again. So this number of 2004 November has the benefit of a very sharp rally that had already happened in the markets. So this is to again get back that paid a high price, stock didn't do well for the first 6 months. In fact, underperformed the markets for the first 6 months till July, August of 2000. If you are not playing the game for the next 6 months, then Infosys was a great stock to own even when it was at the peak valuation way back in November 99. So in conclusion, what are the points that we make here? The single greatest edge that any investor can have is a long-term orientation. Short-term performance envy will inevitably cause many of the shortcomings that lock most investors into a perpetual cycle of underachievement. I mean, just go through every word of it. It is your anxiety about underperforming in the short run and some of your other peers outperforming in the short term that causes you to get into this trap of perpetual cycle of underachievement. To be a disciplined investor, you have to have a philosophy and stick to it even under pressure, and be willing to stand by and watch others make money. There will always be a time when poor quality stocks will make money. PSU banks could be on a roll for the next 6 months. If you still believe in HDFC Bank and Bajaj Finance and Kotak, let those people enjoy and make their money in the next 6 months. You still keep discovering and channelize all your energies to pick the next Bajaj Finance or the next Kotak, not in terms of flipping your portfolio and finding whether it makes sense to invest into a PNB for the next 6 months. Investment philosophy is really not about your high IQ. In fact, I can assure you, high IQ investors are never the ones who have made great returns. It is basically investors who have high emotional quotient who have made great returns in the past. So sticking to your rules is more important than trying to analyze situations, like they say, trying to be ahead of the markets, trying to interpret the macros and then take decisions. I mean, I think this is pretty much true for everything in life, and it is definitely true for investments. All of humanity's problems stem from a man's inability to sit quietly in a room. While you know all the truth that it exists in investments, the problem is that someone or the other always is whispering into your ears that you should indulge yourself into a particular activity or the other if you want to accelerate your returns or accelerate your long-term performance. Whereas you can pretty much do well by sticking to the core principles that we just discussed and shutting yourself into a room. This is what those of you who follow lawn tennis, this is what John McEnroe used to say all the time after his unabated spree of winning Grand Slams. He used to say that the main person who can beat you is always you. So have a belief in yourself, have a belief in your philosophy. If you have done your groundwork very well, if you have gone through the history very well of how wealth is created, don't ever depend on anyone else. Because if you depend on anyone else and you start doubting yourself, you are the one who would be responsible for beating yourself rather than anyone else. So thank you very much.